There is a sequence in monetary history that most people never learn. In the early 1960s, the French government under Charles de Gaulle grew increasingly concerned about American fiscal policy. The United States was running deficits to fund the Vietnam War and domestic social programs. The dollar was still officially pegged to gold at $35 per ounce under the Bretton Woods system, but France's economists believed the arithmetic was unsustainable, that America was printing more dollars than its gold reserves could back. So France began quietly repatriating its gold from the United States. Not loudly, not with announcements designed to destabilize the dollar, quietly, consistently, converting dollar reserves into physical gold and shipping it home. Between 1963 and 1966, France repatriated its gold from the Federal Reserve Bank of New York. Other countries followed the French signal, drawing down their dollar holdings. The pressure on U.S. gold reserves mounted. In August 1971, President Nixon closed the gold window, severing the dollar's convertibility to gold entirely. The Bretton Woods system collapsed. The global monetary order was restructured in ways that are still operative today. The French repatriation was not the cause of Bretton Woods' collapse, but it was a leading indicator of the institutional loss of confidence that preceded it. It was the moment when a major ally, America's oldest ally, quietly signaled that the trust architecture of the existing system had been compromised. Now consider what happened between July 2025 and January 2026. France quietly repatriated all 129 tons of its gold held at the Federal Reserve Bank of New York, the complete position. Every ton. The governor of the Bank of France stated publicly that the decision was not politically motivated. France sold the old bullion, made $15 billion from the sale, and replaced it with updated gold stored in Paris. It was not political. It was institutional. It was the most sophisticated financial institution in France making a portfolio decision about where it wanted its gold, inside the US financial system or outside it. And that decision has a precedent. The last time France made it was 1963. You know what happened 3 years later? This is Capital Briefing. If you are here for the first time, subscribe now before we continue. Turn on notifications. What we build on this channel is the translation of structural shifts in the global monetary order into the framework that lets you understand what is happening before the public narrative absorbs it. Subscribe now. Then let me explain what the data reveals about where the dollar's trust architecture actually stands. Let me start with the most important number in this story, because it is almost never reported correctly. The dollar's share of global foreign exchange reserves has declined from 72% in 2001 to 56.9% in the third quarter of 2025. That is the lowest level since 1995. The IMF confirmed it in their April 2026 Global Financial Stability Report. The way this number gets reported in mainstream financial media is usually dismissive. The dollar still dominates. 57% is a majority. No alternative comes close. That framing is technically accurate and analytically incomplete. The relevant question is not whether 57% is still a majority. It is, what does a decline from 72% to 57% over 25 years mean structurally? And more importantly, what is the trajectory and what is accelerating it? The answer to both questions is the same. The trend is downward, and the acceleration mechanism is not what most analysts focus on. Most analysis of de-dollarization focuses on the yuan's rise, on BRICS cooperation, on China's economic weight creating a gravitational pull toward renminbi internationalization. These forces are real. But they are secondary to the mechanism that is driving the current acceleration. The primary mechanism is trust erosion driven by weaponization. In February 2022, the United States and its Western allies froze $300 billion in Russian central bank reserves. Not Russian private assets, not sanctioned oligarchs' personal wealth. The foreign exchange reserves of a sovereign central bank, assets that every convention of international monetary law had treated as protected. The decision was arguably justified. Russia had invaded Ukraine. The response was a deliberate use of the dollar system's plumbing as a geopolitical weapon. But the consequences extended far beyond Russia. Every central bank in the world that held significant dollar reserves watched what happened. And every central bank with any complexity in its geopolitical relationships ran the same calculation. If the United States could freeze Russian central bank reserves, what would happen to our reserves if our relationship with Washington deteriorated? The answer to that question, even the fact that it is now a question that central banks are asking, fundamentally changed the risk calculus of dollar reserve holdings. U.S. sanctions programs have expanded from 120 countries and entities in 2001 to more than 900 designations by 2024. The dollar system's infrastructure, SWIFT messaging, correspondent banking networks, the Treasury's OFAC enforcement, has been converted gradually and then rapidly from neutral global financial plumbing into an instrument of American foreign policy. One analyst quoted in Fortune in May 2026 described the consequence with precision. Washington cannot both weaponize the dollar system and maintain universal trust in it. That is not a prediction. That is a description of an observable tension that has been building for 2 decades and is now producing measurable institutional responses. Subscribe to Capital Briefing if this framing is delivering the structural context you have been looking for. Turn on notifications. The next video on this channel examines how the specific mechanics of sanctions exposure work, how central banks calculate their vulnerability, what the practical architecture of reserve diversification looks like, and what the historical timeline of past reserve currency transitions tells us about the trajectory we are currently on. Subscribe now. Then let me take you through the specific signals that most people are not reading correctly. The France repatriation is the most symbolic signal, but it is far from the only one. Canada announced a $25 billion sovereign wealth fund in May 2026, specifically designed to reduce economic dependency on the United States. Canada, America's largest trading partner, America's neighbor, the country that shares the world's longest undefended border with the United States. When Canada is building infrastructure to reduce U.S. economic dependency, the nature of the trust erosion has expanded beyond anything that can be attributed to adversarial geopolitics. China has cut its U.S. Treasury holdings by more than 27% since 2022. The country has gone from holding approximately $1.3 trillion in treasuries at its peak to approximately $730 billion today. That is a reduction of more than $500 billion in U.S. Treasury holdings, the largest voluntary divestment from U.S. sovereign debt by a foreign holder in modern history, and it is ongoing. The petrodollar system, the 50-year arrangement under which Gulf oil producers priced oil exclusively in U.S. dollars and recycled surplus revenues into U.S. Treasury bonds, has experienced 2 landmark challenges in recent years. In June 2024, Saudi Arabia chose not to formally renew the petrodollar agreement, ending an arrangement that had been continuously operative since 1974. In February 2026, Iran effectively closed the Strait of Hormuz to Western-linked shipping, offering passage to tankers settling in yuan. India is now settling Russian crude oil purchases in yuan and dirhams, 60 million barrels per month. That is not a token transaction. That is a meaningful portion of India's energy import volume flowing through non-dollar settlement channels. The CIPS system, China's cross-border interbank payment system, developed as an alternative to SWIFT, processed 750,000 transactions in a single month in March 2026. Its annual business volume reached 180 trillion yuan, approximately $25 trillion, in 2025. It connects 4,900 banking institutions in 187 jurisdictions. To be clear, CIPS processed about 3% of global SWIFT payment volume in 2026. Dollar dominance in transaction settlement remains overwhelming, but the trajectory matters more than the absolute figure. CIPS grew 43% in annual volume in 2024. It is not replacing SWIFT, it is building the alternative infrastructure that makes SWIFT replacement conceivable at some future point. The distinction between what exists and what is being built is the distinction between present reality and future optionality. Sophisticated institutions do not wait until alternatives fully mature before they begin positioning. They position during the construction phase, when assets are still cheap and the transition is still contested. Now let me explain what makes this particular moment in de-dollarization history categorically different from every previous episode, every previous serious discussion of de-dollarization. In the 1970s, in the aftermath of the 2008 financial crisis during the Eurozone debt crisis, was driven primarily by adversaries or by countries with explicitly competitive relationships with the United States. What is happening in 2026 is different in a way that monetary historians will discuss for decades. The countries now actively reducing their exposure to the dollar-based financial system include France, Canada, and other established Western allies, countries with deep institutional, military, and economic ties to the United States, countries that have no adversarial agenda, countries that benefit from the dollar system and are still choosing to hedge against it. A market analyst at EBC Financial Group articulated this distinction directly in May 2026. These are not the actions of enemies. They are the actions of allies and partners who have watched the United States weaponize the dollar-based financial system and have quietly concluded they need to reduce their exposure to it. The analyst described what is happening as different from anything in the past 80 years of dollar dominance. When adversaries reduce dollar exposure, it can be attributed to geopolitical competition. When allies reduce dollar exposure, it is an institutional judgment about the reliability and neutrality of the dollar-based financial architecture. These are fundamentally different signals. And the second kind is the one that has historically preceded structural monetary transitions. Let me now walk you through the gold signal, because it is the most measurable and the most historically grounded indicator of what institutional creditors think about the reliability of the dollar-based system. From 2022 through 2024, central banks collectively bought more than 1,000 tons of gold in each consecutive year. The 2022 total of 1,082 tons was the highest since 1950. The trend continued through 2025 with 863 tons. Below the three-year peak pace, but still well above the long-run average. Gold's share of global reserves has risen from 13% in 2017 to approximately 30% in 2025. This is not investment behavior. Central banks do not buy gold for yield. It pays no interest and incurs storage costs. Central banks buy gold for what it is at the deepest level of the monetary system. The only reserve asset that is simultaneously no nation's liability, immune from financial sanctions, physically possessible, and recognized universally across every monetary system in history. The concentration of gold buying among specific countries tells the story directly. Poland added 102 tons in 2025 for the second consecutive year. The governor of the National Bank of Poland cited national security reasons. The Czech Republic, Kazakhstan, Brazil, Turkey, China. The pattern of buyers is consistently concentrated in countries with direct geopolitical exposure to the dynamics that make dollar reserves potentially vulnerable. BRICS plus nations now hold 17.5% of global gold reserves, up from 11.2% in 2019. The bloc that represents nearly 48% of the global population is systematically accumulating the one asset that cannot be weaponized through financial sanctions. Now let me explain why the public narrative on this topic is almost entirely wrong, and why that gap matters for anyone trying to understand what is actually happening. The public narrative on de-dollarization runs on two tracks simultaneously, both of which are misleading. Track 1. The dollar is dying. This framing treats de-dollarization as an imminent event, a rupture that will be visible and sudden. It is wrong because reserve currency transitions are among the slowest structural processes in financial history. The British pound's decline from 60 to 70% of global reserves in 1913 to negligible levels in the 1960s took approximately half a century. The dollar is not dying. It is not being replaced next year or the year after. Track 2. De-dollarization is overblown. This framing treats the current trends as noise, marginal movements in reserve composition that have no structural significance. It is wrong because it confuses the pace of the transition with the direction of the transition. The direction has been consistently downward for 2 decades. The pace has been accelerating for 4 years. The mechanism driving acceleration, sanctions weaponization creating institutional creditor risk, is not going away. The accurate framing is neither track 1 nor track 2. It is this: reserve currencies collapse psychologically before they collapse financially. The dollar is not collapsing financially, but the trust that underpins its role as the neutral infrastructure of global trade is being eroded incrementally through the accumulation of decisions by central banks, by allied governments, and by institutional reserve managers to reduce dependency on a system whose neutrality can no longer be assumed. That erosion is slow. It is measured in percentage points per decade rather than per year. But it compounds, and once the compounding crosses certain institutional thresholds, once enough central banks have built enough alternative infrastructure, once enough payment volume has migrated to alternative settlement systems, once enough gold has been accumulated outside the Western custodial system, the transition accelerates in ways that nominal reserve share data does not capture in real time. The world still uses the dollar, but fewer countries fully trust the system behind it. That is a different kind of risk than dollar value risk. It is structural risk, and it manifests not in the exchange rate today, but in the capital flows, the reserve compositions, and the infrastructure investment that shape what the exchange rate looks like 5 years and 10 years from now. Let me now address the historical parallel that the France gold repatriation invokes, because it is the most important single data point in this entire story. The 1963 to 1966 French gold repatriation was the most visible institutional signal of the confidence crisis that preceded the collapse of Bretton Woods. But France was not acting in isolation. It was acting on an analysis that several other countries shared, that the US was running deficits that the gold standard could not sustain, that the dollar's official convertibility was increasingly fictional, and that physical gold held at the Federal Reserve was an exposure to a system that might not honor its commitments at some future moment of stress. The US government's response was to reassure its allies that Bretton Woods was stable. Treasury officials described the French action as disruptive and motivated by Gaullist nationalism. The gold window stayed open for 5 more years. Then in August 1971, it was closed in a weekend announcement that restructured the global monetary order without consultation with any of America's allies. The allies who had worried were right. The allies who believed the reassurances were caught off guard. The 2025 to 2026 France repatriation invokes this precedent precisely because France was the country that read the signal correctly in the 1960s. When France makes the same institutional judgment again, pulling its gold home, the historical context is not background color. It is the central interpretive frame. Is France right this time? History suggests that when a major institutional creditor makes a conservative, quiet decision to reduce exposure to a system it has historically trusted, the probability that its concerns are well-founded is higher than the probability that they are wrong. That is not a prediction. It is a base rate from 500 years of monetary history. Now let me close with the most important practical observation from everything I have described. The dollar is not ending. The dollar-denominated financial system is not collapsing. US Treasuries remain the deepest and most liquid sovereign debt market in the world. SWIFT continues to handle the overwhelming majority of global transaction volume. None of this is in immediate danger. But the architecture of trust that makes all of this possible is being tested in ways that have no modern precedent. The weaponization paradox, the observation that Washington cannot both use the dollar system as a foreign policy tool and maintain universal trust in its neutrality, is not a problem that can be solved through more effective messaging. It is a structural tension that is built into the choices that have been made. And the institutional responses to that tension, France's repatriation, Canada's sovereignty fund, China's treasury reduction, central bank gold accumulation, CIPS growth, petrodollar erosion, are not synchronized. They are independent decisions made by independent institutions that have all reached similar conclusions about the same structural risk. When independent actors converge on the same behavior, the convergence is the signal. Not any single actor's decision, but the pattern across all of them. The pattern is clear. The direction is established. The pace is a question. The destination is not. The dollar will continue to be the world's dominant currency for the foreseeable future. But the world it dominates will be structurally different, more fragmented, more multipolar, more cautious about the neutrality of dollar-based infrastructure than the world of 2010 or 2000. Every portfolio built on the assumption of 2010-era dollar trust is carrying unpriced structural risk. The question is not whether the shift is happening. The data is unambiguous. The question is whether you have processed what it means for the things you own. Subscribe to Capital Briefing now if this video changed the way you understand the relationship between dollar trust erosion and your own financial positioning. Turn on notifications. Leave one comment, one number. What do you think the dollar's share of global reserves will be in 10 years? Because the institutions that are building portfolios for that answer are not waiting for consensus. They are already moving